Fundamental analysis, one of the components is economic analysis. Economic analysis is analyzing the macroeconomic of the country. But why? Why do you need to spend your time analyzing the whole country's economic status just to invest in one country? The answer is simple. Because in the world, if there are two companies, think of it, one is found here in America and one is found here in Afghanistan. Probably both of these companies might have the same potential, the same capital. However, for you as an individual investor, it's better for you to invest in the company who is in America rather than who is in Afghanistan, because the risk is minimized when you invest in a country that is stable and growing. It's less risky, so it's better to look at every country you want to invest your money on before looking at the specific company in that country. So in economic analysis, you might look at this different factor. One is GDP. If the GDP means the total number of products produced in that country. If it is high, it's probably best to choose the company you invest on in that country rather than any other country. If the company has a growth, if the country is growing country or has rapid growth, it's better to invest in a company that's present in this country. The other one is trend in public investment and saving. This is more related with interest rate. Let's just look at two different scenarios. You know that there is something called the bank borrowing rate and bank lending rate. What's bank borrowing rate? A bank borrowing rate is what a bank pays you when you deposit your money. When you deposit your money, you are lending the bank, and the bank is borrowing your money. So the interest payment that he made on your deposit is called bank borrowing rate. However, when you take your money, when you take the bank money, when you borrow from the bank, you will pay the interest. From the bank's perspective, it's lending activity. The money the bank gets from lending his money it came from the bank lending rate. So bank lending rate is what the bank charges you when he lends your money, his money. However, bank borrowing rate is what a bank pays you from your deposit. So let's look at a scenario when the interest rate drops, which is a bank borrowing rate is 10%, you get 10% from your deposit, or the bank lending rate is 12%. You will pay 12% for the bank if you borrow. A bank, and one scenario is when the interest rate goes up. We'll talk in both scenarios what will happen. The first one is when the interest rate drops. What if it is 10%? As an individual, what will you do with your money if the interest rate is too low, like 10% in the country? Because we are looking from the macroeconomics. This means every bank or most of the banks lends you with 10%. Pays you 10% on your deposits in that country. This may differ from country to country. For example, in this country, probably most of banks pays 10%. However, when you came in this country, most of banks might pay 20 or 30%. So what would happen if the interest rate drops? As an individual investor, think of it. Most of the time there is a higher probability that the investment will rise and saving will decline. The reason is, if you have money, you don't want to deposit your money in the bank. Rather, it's better for you to invest in any other investment, because you might probably get a return more than this 10% little interest rate. However, if you deposit your money in the bank, you will wait this fixed payment 10% only, which is the lowest. Also, people tend to borrow from banks in order to invest in some other investment areas, because if they found the interest rate, they pay 12%, which is the lowest. Why don't they borrow? They borrow from the bank because this is a minor little interest that they have to pay, so they will invest. This means saving will drop. Nobody deposits his money in the bank in order to get this little amount of return. Also, investment will encourage, because people borrow money from the bank because the interest they pay is too low. So after borrowing, they invest their money, which increases the total investment in the country. However, what will happen if the interest rates goes up? Will you deposit your money in the bank, or you will tend to borrow and